Hello and welcome everyone to another market commentary with StashAway. With us, of course, our Chief Investment Officer, Freddy Lim. Hey, Freddy.
Hi.
Good to have you again. We want to dive right into it, right?
Yes.
I think obviously the COVID-19 situation is still here, right?
Compounded by the oil shock.
Compounded by the oil shock, not to forget, which we mentioned last week as well, right? And dived a little bit into this. Obviously, developments right now are just accelerating, right? Because it's spreading into the other countries, kind of what we have felt in Singapore, in this Asian region already a few weeks ago, right? Do you want to give us a little bit of an update what's going on in this situation and how do we look at it from a StashAway perspective?
Yes, I mean, a lot is happening right now. There's a lot of negative a while back and there's a lot of positive streaming in now. But before we get in there, I would just want to say that, it's understandable that investors are anxious.
Yes.
Because you are enduring right now some of the most speediest, unprecedented market drawdowns ever. And I'm very sorry to see us all having to endure it, but it's also a good time to look back into past evidences, past crises, crashes, and post those events, what was the right move to act on. So today we're going to step back a bit, look at progresses in China, then look at the pandemic a little bit more globally, which is a little bit still on the spiral. But there's also a lot of policy actions that we're going to talk about, right? So let's do a very, very thoughtful analysis on this whole thing. So that would be my hope, my big target for the day.
Yeah, so hopefully everyone is a little bit better informed what these events mean and what is happening from a financial perspective, financial market perspective, right, in this case.
Exactly.
So why don't we dive right in then, Freddy?
Okay, we're going to show you a slide here. Let's first start with what's happening in China, the epicenter of it all. I would say that the WeBank's big data analytics have shown quite a lot of interesting development in China, where in particular the CERI index, which is the China Economic Recovery Index, which is a aggregated mobility data that's weighted also by each city's share of China's GDP, and is looking at movement and how activities are whether they are resuming or not. This is one of those very new big data thing that Chinese entities have been able to produce. And the WeBank CERI index has shown that back in February, in the midst of the lockdown, China was about 21% of its usual mobility. And by as of the middle of March, this has gone up dramatically back to 70%. 70%. And we have heard anecdotal evidence such as Apple reopening all of its stores in China. The hours are still shortened, but it's in a step in the right directions. And there's the other interesting one, which are the calls of ships to land, to move things into the ports of China. There's a data called daily port calls in China. That number, as you can see on the bottom right chart, the orange line is actually what's happening this year by the days, and the blue line was last year. So this tells you the deviation from last year and the impact of the coronavirus. As you can tell, during the lockdown, the orange line went way down, but we have a dramatic recovery in the numbers back to normal. 800 calls to the ports per day now, right? The left side, the CERI index I just told you. So these two numbers are sort of the advanced leading indicators of China's very good progress in managing the virus, right? Now moving on, the right side is what's been happening in China. As you can tell, Jan 22nd is when we first have those lockdowns. And about a month into the lockdown, you can tell on the right chart, the numbers is quite usual that it's still spiking up. But it starts tapering off around a month from there. And 2 months from then, China has barely added any more new cases. So the left side is actually quite interesting because the first part of from Jan 22nd to March 12th was entirely China's number. But now China has stopped contributing to the global number, and the global numbers is now a global ex-China number is spiking up. So what it means is that yes, China has got very good progress, But however, it's been overshadowed by the global infections elsewhere. We need to see progresses in other big cities as well. So I think the market is going to be very focused on whether Italy and Germany and the US could really fight this out proper, right? So the battle is ongoing with the virus. Now, this is really coming in fast, something what we call policy bazookas. Bazooka was a term used to refer to Governor Mario Draghi's big shock and awe therapy of the economies back in the global financial crisis in 08-09. To coin him, whatever it takes was the word.
Yes.
And it led to the media coining his term, his action as the bazooka. Today, we're not seeing a bazooka, we're seeing policy bazookas streaming in from everywhere else. Number one, just is not, the list is really long. We cherry pick from the main ones. And as we speak, new ones are coming out. Yeah, so this is not an exhaustive list. So let's start with the bottom. Singapore was one of the very, very, very proactive, very early countries that was very good in managing it outside China. It started early with a targeted budget for 2020, targeting a deficit of 2.1% of GDP to support the economy. Then that's followed up by a lot of liquidity provision by global central banks. I wouldn't go through the detail, but the PBOC has been quite restrained in just normal pump and dump sort of behavior, but they have been very targeted. They cut required reserve ratio for banks, which free up $79 billion of capital. And then the Fed pledged early on, before they did anything, they pledged a cumulative total of liquidity provision of at least $5 trillion of cash.
Yes.
And they have started doing 3 tranches of that liquidity provision.
Yep.
Each one is about $500 billion. There were 3, so it's $1.5 trillion so far. They can do a lot more than that. The EU, European Union, relaxes the strict budget rules, which is why Italy can raise budget. I think it's more than 4 times now within a month.
and before they were really strict on it always, right?
Yeah.
Exactly.
And so I think as of now, the numbers are still going up. At first, the rescue packages were just 8 billion euro. It's gone up to 25 billion euro in Italy. Other member countries in the EU could also ramp up their support packages now with the relaxation of the budget rules. And then really the bazookas came in even further with the US Federal Reserve surprising the markets by cutting rates from 1% to 1.25% band to around 0.25%. Again, we're back to very close to zero. And US banking regulators at this very moment, they're considering loosening the capital requirements that they have imposed since the crisis to free up more banks' capital for lending and for more productive activities. Currently, the ECB has done one up the US, where they straight away jump in and free up $112 billion of banks' capital. That's followed by Canada launching a fiscal stimulus equals to 3% of GDP, upping Singapore's number. And then ECB came in with an emergency bond buying program worth Euro 750 billions. That's about 825 billion US dollar. Then the big one.
The US, yeah.
the Trump administration managed to work things out with the Democrats, and the Congress were swiftly able to implement
which is quite interesting that it takes a crisis for politicians to
come together
and make quick decisions, and they actually work, right?
Yes,
where
exactly.
Normally things take forever to get passed by anyone.
And this one is humongous.
Yes.
This one is $1.3 trillion in total for now. The Senate is already planning the next months. And in this $1.3 trillion of stimulus, $500 billion are going to be actual checks made out to individuals, going out to household. They will send those checks to the mail, and people expected to hit the bank accounts within the next 3 weeks. And in that packages, $1,000 per adults and $500 per children. So this is massive. And there's also the airlines are in distress, and it's quite likely that a lot of people by now think that they can be nationalized. What's going to happen is in this package, the US has budgeted $50 billion in loans to distressed airlines So rather than owning and bailing them out and become nationalized, they're providing loans to them. But this very well could morph into the government becoming a shareholder.
Yeah.
The airline industry as a whole has asked for $58 billion. They're getting 50.
Yeah.
And there's another $150 billion to go around to other distressed sectors, and $8.3 billion for emergency healthcare related costs relating to the coronavirus.
Which is a huge one. Right?
This is huge, and it's the beginning of more to come, right? So the summary is the policy bazookas are streaming in from every channel. And because of this unique situation, we felt that it's good to review what we learned from the 2008 global financial crisis. And so on this chart, the main conclusion is, let's go through it. If you can look at the middle of the chart, where back then there's only one bazooka when the policy stimulus from the Fed came in March 2009. And that also coincided with the bottom because the bazooka was big enough that the market rebounded strongly. And back then, as you can tell, the black line, which is the Conference Board Leading Economic Index, it was negative 20% year on year. And as you can tell, as the bazooka came in, the right side of that V path was generated by the policies. So market was following the lead of policies, but the economy was following the lead of the market roughly a year and 3 months later. So the whole time the black line was going up, it wasn't positive. It was going from minus 20 to minus 10. It's less and less negative, but you are technically in a sort of a contraction mode. And it took a year, by around early 2010, before the market crossed zero and started growing for the first time again. So policy bazooka leads the market. Market eventually leads the economy. This can very well happen from here. Of course, there's no crystal ball as to exactly how we get there. Is it a V? Is it a U? Is this a more whipsaw before we get there? And the time to get there, who knows? But the good thing, we know that policy responses this time is much faster and much bigger than back in 2008. As you know from this chart, it took, from the peak to bottom, it took from 2007 Q4, it took us to March 2009 to see the policy bazooka. That's a year and 3 months delay. Right now we had it within a month and a half, right?
Super quick.
Yes. So, however, the path is not clear, but the destination, the final destination is clear. And it is from this experience and learning from here that, and myself having gone through it, I was working at Morgan Stanley and having gone through, was in the midst of that storm when I was on Wall Street. And it was with these lessons that I remember that the policy bazooka really matters, and that investors are better off staying invested. And here, this slide outlines exactly why. How does policies, how does it work, and where does it lead to? So first, we're seeing governments globally launching massive spending programs. Check, that's happening right now. Number two, the governments have to finance these programs. But how are they going to do it? They have to issue bonds, and so they might actually spook the bond markets because of supply concerns. Checked, actually just happened.
Correct.
As you knew, there were massive drawdowns in protective assets like bonds as well. And that's already happened. But the next step is that all the quantitative easing programs from central banks are going to come in. They're going to buy government bills, bonds, commercial papers, asset backs. They're going to come in and effectively financing these programs in an indirect manner. 4, yields go everywhere, raise to zero. 5, the intended consequence of this is to induce spending and investment. Why? Because when you hold cash in the bank
and you don't get anything, right?
There's no earnings, there's no income, there's no dividends, there's no interest rates.
You have to invest it somewhere, right?
Yes, you're diluted. The purchasing power of the money, the earnings power of the money are going to go to zero. And you have to, the only way you emerge winner is to stay invested. A la 2008's final experience. So this is what quantitative easing policy stimulus are about. We've seen it happen before in a very big scale, and this time it's no different.
So, well, thank you, Freddy. I think that was super in-depth and I think a very, very good overview of what's happening, because I think there's so much. Everyone concentrates on all the health-related news right now, right? And it's so depressing, and so there's no good news yet, really, on that side. So it's good to see and put it actually in perspective here, right?
On that front, you're right, because it's happening so personally around us.
Correct.
And I do acknowledge that we do have to be cautious with our physical surroundings.
Yes.
But there are actually good news that's been ignored. You know, Japan has already got a drug that's been actively used in Wuhan, and the test statistics are massive. There's a lot of data, and the Chinese authorities have already expressed very strong promise. It's very looking promising, based on their test experiences in Wuhan,
yes.
the epicenter of it all. And so there are some very, very good development in the pipeline, right?
Yeah.
But there's also a lot of scientific simulation that shows you all sorts of numbers everywhere.
Correct. And I think the news in general, right? They like to have bad news, right? Because it sells more, it gets people glued to the internet websites and the screens, right? So I think putting it into a financial sense is what people really need. And I think you did that really well there. Thank you so much. We do want to address, though, a couple of questions that we've been getting, right? In general, like we always do. So if those questions are not coming directly from you, feel free to put them in the comment box below anytime. So we'll pick them up over the next few weeks. But we have a couple that were quite interesting that you wanted to address, right? And the first one is, can you clarify why, for example, you use time-weighted return and money-weighted return, right? And there's a lot of confusion around it. If you're not in finance, it's very difficult to grasp, right? Can you make it a little bit easier for people to understand that?
This is actually a very interesting question, and it highlights that there's many different correct measures of returns, but the dollar amount can still be the same. So let me jump straight to it. Time-weighted return is, it traces the first dollar, the first time when an investor invests in a portfolio, to the time now. So it's a true measure of your performance in the period, whereas money-weighted return accounted for your timing of cash flow, of where maybe you have invested additional dollars over time, or maybe you have made some withdrawals in between the period. So it can be a little bit more difficult to understand, but an example would help. So for example, imagine when the market is down, and an investor actually actively contributed and bought at a cheaper level than before and contributed more investment amounts. And then subsequently, when the market recovers, this investor's money-weighted return is going to be higher than the time-weighted return. So essentially what it means is that money-weighted return is essentially accounting for the fund manager's performance purely, which is the time-weighted return, plus the performance, the behavior of the investors.
Correct.
If the investors have made the right call and is getting rewarded for the rebound, the money-weighted return goes up. Conversely, when an investor, if you suffer from FOMO and you buy on the high and the market actually had a drawdown, your money-weighted return would be a lot lower than the time-weighted return. But the right measure when to evaluate risk, when you have a risk budget, whether you bridge it or not, is really to look at a time-weighted return. There's a cleanest measure of a portfolio's performance that's not distorted by cash inflows and cash outflows. It's not a combination of your performance and the fund manager performance. It's purely just a portfolio's performance.
No, I think that clears up a lot of the confusion, Freddy. And if you ever have any questions about this, right? Also, our client engagement team is here, right? We're only an email, call, or WhatsApp away. Happy to address any of your questions about that. Let's move on to the second question, right? That we got a lot lately. It's also, should I, as an investor now, right, change my risk level or the portfolio I'm in with StashAway? Does it make sense right now?
Well, I assume that before you invest your first dollars and you've gone through your financial plans, and that plan has detailed the amount of cash buffer you need in terms of number of months of living expenses in cash. You may deploy the cash into a fixed deposit account or the cash management portfolio like StashAway Simple, but that they're very liquid, they are emergency funds, right? That's first. And then you invest anything over and above your cash buffer in a systematic manner.
Just to chime in there for a second, you know, I know we've been stressing this so much to have an emergency fund, right? And I think this is the time exactly to stress this one more time. These are the situations why you have emergency funds.
So that when you need your cash to sort of pay bills and expenses, you have X amount of buffer to draw on first. You don't sell your portfolio on the low.
Correct.
And actually with more time, there's higher probability of success with your portfolios. So that's exactly why this is very important before you invest.
Correct.
Right. And two, in terms of what's already been invested, you should stay invested.
Yes.
Right? Again, the same perspective. But in terms of if your circumstances hasn't changed, right? You still have your regular income, and you may review your spending plans, and you may want to change your net savings, you want to increase it, or whatever the personal circumstances is. You continue whatever net savings you have going forward. If you have net savings, invest them periodically. If it's monthly cash flow, invest monthly. Those things don't change as per your investment plans.
Yeah.
You're preparing for your retirement in 30 or 40 years from now, or sending a child for education in 10, 15 years. Why should a few months or a few quarters of negativity, or even a year of bad news affect your long-term plans? And as we said, there are a lot of reasons when you have crashes or unpredictable black swans. In all historical cases, the big extreme cases we studied, it's a matter of time before you recover.
Yeah.
The path of getting there is hard to predict, but the final destination is very clear.
Yes.
And that means, and the bazookas as well, it's just telling us the same thing. Whatever is invested, you got to stay invested. Whatever you can invest in the future will be based on your savings minus your expenses. So those things remains unchanged.
Yeah. No, I think that good summary for that question. So again, if you have any more, please let us know in the comment box, right? Freddy and I look at them and we'll pick them up over the next weeks. One other thing I really wanted to mention as well is because, you know, people might ask, hey, what are your business continuity plans at StashAway? And I know a lot of our customers are affected themselves, right? You know, you all work here in Singapore. There's a lot of working from home happening, right? A lot of companies are splitting their teams. And I want to just mention, we're doing the same. We're in the fortunate situation being a fintech company, right? That we can do a lot of work remotely, right? So we actually also have teams split between the office and their homes. So you don't have to worry about any kind of disruptions to the platform, the app, the trades, or anything like this.
Well, throughout the whole Tumultus experience so far, we have had very good operational experiences. Correct. And I think technology efficiencies are the backbone of a fintech company.
Yes, and I think that really exactly that puts up in this situation that is actually that we can comfortably say that this is actually working super well for us right now. Again, thank you so much for listening. I hope you found this analysis from Freddy for the markets helpful. Again, comments, questions, put them below the video, and we'll be definitely back with you next week. Other than that, we hope to see you soon. Bye-bye.
Ciao.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.